December 20th, 2025, silver is at $67 per ounce, all-time highs, up 130% for the year, the strongest annual performance since 1979. And while everyone's watching the price, almost nobody's asking the most important question: how did we get here? Because the answer isn't in the charts, it's in the vaults. Specifically, JPMorgan's vaults. Let me show you something that should make every market observer pause. According to CME data from December 2025, JPMorgan holds approximately 196 million ounces of silver in the COMEX system. That's roughly 43% of the exchange's total inventory. Not 4%, not 14%, 43%. One bank controlling nearly half of the world's most liquid silver market. And that's just what's reported in COMEX vaults. Industry sources estimate JPMorgan's total silver position, including custodianship of the iShares Silver Trust, at over 675 million ounces. That's worth approximately $45 billion at current prices. This isn't speculation. This is documented public data. And the story of how JPMorgan accumulated this position is one of the most remarkable strategic plays in modern commodity markets. Because 15 years ago, they were on the opposite side of this trade. They were short, massively short, and that position nearly destroyed them. In 2011, silver was surging toward $50 per ounce. JPMorgan was caught holding what analysts estimated to be a 200 million ounce short position in paper silver contracts. They were betting prices would fall. Instead, prices exploded. This was a commercial short squeeze. And the most likely commercial entity being squeezed? JPMorgan Chase. But something interesting happened in March 2011. Right in the middle of that price surge, JPMorgan was suddenly approved to establish their own COMEX silver vault. Within 60 days, they had brought in 750,000 ounces. The total amount of silver held in all vaults at that time was just over 100 million ounces. What happened next is where the strategy becomes clear. From 2011 through 2020, JPMorgan systematically accumulated physical silver while maintaining their paper short position. They were short on paper while going long on physical metal. Every time silver prices fell, they accumulated more physical. Every time retail investors panicked and sold, JPMorgan was buying. They used the delivery process on COMEX to steadily build their position. According to analysis of COMEX delivery data, in 2015 and 2016 alone, JPMorgan's house account accumulated approximately 51 million ounces of silver on a net basis. By 2017, JPMorgan's vault held 107 million ounces of eligible silver. By 2020, that had grown substantially larger. Now, here's where history matters. Because JPMorgan wasn't just accumulating silver quietly, they were also settling allegations of market manipulation. In September 2020, JPMorgan agreed to pay $920 million, the largest commodity market manipulation fine in history. The CFTC found that for at least 8 years, from 2008 to 2016, JPMorgan traders engaged in spoofing precious metals and treasury markets. The settlement included $436 million in civil penalties, $311 million in restitution, and $172 million in disgorgement. JPMorgan admitted wrongdoing. 3 traders were charged under RICO statutes, laws typically used for organized crime prosecutions. The Justice Department entered into a 3-year deferred prosecution agreement with the bank. This is not conspiracy theory. This is settled legal fact. JPMorgan paid the fine, admitted to manipulative trading, and agreed to compliance reforms. But here's what the settlement didn't do. It didn't force them to unwind their physical position. Because physical ownership isn't manipulation, it's positioning. By 2020, JPMorgan had positioned themselves for what was about to happen next. Fast forward to 2025. Silver began the year at $29 per ounce. Industrial demand was surging. Solar panel installations doubled in 2024. Every panel requires silver paste. Electric vehicle production was up 40% year over year. Every EV uses twice the silver of a combustion engine. 5G infrastructure, data centers, defense systems, all increasing silver consumption. Industrial demand hit 680 million ounces in 2024, projected to reach 750 million in 2025. At the same time, mine supply was declining. Global silver production has fallen roughly 7% since 2016. Most silver comes as a byproduct of copper, lead, and zinc mining. When base metal demand is weak, silver supply doesn't increase even when silver prices rise. The market entered a structural deficit, consuming more silver than mines produce for 7 consecutive years. Then came the vault drain. In early December 2025, over 47 million ounces of silver were claimed for delivery from COMEX in just 4 trading days. That's more than 60% of total registered silver inventory. The December delivery surge was unprecedented. Normal months see 5 to 10 million ounces delivered. December saw nearly 50 million in the first 4 days alone. According to market data, COMEX open interest reached 244% of vaulted silver. That means paper contracts outstanding exceeded physical metal by more than 2 to 1. When participants began demanding physical delivery instead of rolling contracts, the system faced stress. And here's where JPMorgan's position becomes significant. They hold 43% of COMEX inventory. They're the custodian for the iShares Silver Trust, holding 517 million ounces worth $32 billion. In any physical delivery squeeze, they're sitting at what analysts call the silver gate. Reports from June through October 2025 indicated the bank methodically closed its entire short position, redirecting capital to physical accumulation. If accurate, this would represent a complete flip from net short to net long. The bank that spent years allegedly suppressing prices through paper shorts would now be positioned to benefit from rising prices through physical holdings. The timing is notable. In November 2025, JPMorgan relocated its precious metals trading team from the United States to Singapore. This move positions them closer to Asian industrial demand, particularly from China, which is the largest consumer of silver. It also distances operations from Western regulatory scrutiny. Let's talk about what $67 silver means. In 1980, when the Hunt brothers tried to corner silver, prices peaked at $49.45. Adjusted for inflation, that's approximately $170 in today's dollars. We're at 67 cents, which is 40% of the inflation-adjusted 1980 peak. But the fundamentals are different now. In 1980, the Hunt brothers relied on paper contracts and leverage. They had no real industrial demand supporting prices. When COMEX changed the rules, banning new long positions and forcing liquidation only, the squeeze collapsed. Silver Thursday, March 27, 1980. The Hunts were destroyed. JPMorgan's approach is the opposite. They hold physical metal, not just paper contracts. They've accumulated slowly over 14 years, not rapidly over months. They're positioned as industrial suppliers, not market manipulators. And most importantly, industrial demand is real and growing. This isn't a speculative bubble. This is a structural supply deficit colliding with genuine consumption growth. Market analysts are now projecting silver could reach 75 per ounce by the end of 2026. Some independent analysts have discussed targets of 90 to 100, citing the supply deficit and positioning dynamics. But here's what makes this different from typical commodity rallies. This isn't just about investment demand or speculation. This is about industrial consumption that cannot easily be substituted. The gold to silver ratio tells another story. Historically, silver trades at a ratio of about 15 to 1 compared to gold. Recently, that ratio has been around 72 to 1. In December 2025, it dropped below 65 to 1. When this ratio reverts to historical norms, and historically it always does eventually, some analysts suggest silver could trade at 280 per ounce based purely on ratio reversion. This is not a prediction. This is mathematical observation of historical patterns. Now, let's address what this means practically. If JPMorgan holds 675 million ounces at $67 per ounce, that's $45 billion in value. If silver reaches $90, that position is worth $60 billion. If it reaches $100, or $67 billion. This is one of the largest commodity positions ever assembled by a single institution. And it's been assembled quietly, systematically, over more than a decade. The broader implications extend beyond JPMorgan's profit potential. This positions the bank as a gatekeeper in a critical industrial input. Governments pushing renewable energy transitions, electric vehicle adoption, and grid modernization all depend on silver-intensive technologies. If supply remains tight and one entity controls a dominant share of available inventory, that creates leverage. The November 28, 2025 COMEX outage adds another dimension. The CME experienced nearly 11 hours of downtime due to what was described as a data center cooling issue. During that outage, silver spiked to 56.72 per ounce. When systems came back online, bid-ask spreads were over $1, indicating illiquidity and stress. This raises uncomfortable questions about market structure. Should one institution control 43% of an exchange's inventory? Should that same institution be the custodian for the largest silver ETF? Should they be allowed to trade both physical and paper positions simultaneously? These are regulatory questions that extend beyond JPMorgan specifically to market design generally. For those trying to understand what comes next, the framework is structural rather than speculative. Supply deficits are projected to continue through 2026 and beyond. Industrial demand is growing faster than mine supply can respond. Above-ground inventories are being drawn down. COMEX registered silver has declined from over 180 million ounces in 2021 to approximately 113 million ounces in November 2025. That is a 37% decline in available delivery supply while demand increases. When paper markets face physical delivery pressure, several outcomes are possible. Prices rise to incentivize supply and reduce demand. Premiums for physical metal over paper prices increase. Delivery delays extend, or in extreme cases, exchanges change settlement rules, forcing cash settlement instead of physical delivery. Silver is approaching a similar inflection point. The question isn't whether supply constraints exist. Data confirms they do. The question is how markets adjust. JPMorgan's positioning suggests they're prepared for either scenario, but positioned to benefit most from structural adjustment. The $67 silver price in December 2025 isn't the end of this story. It's confirmation that structural forces are overwhelming paper market dynamics. For 45 years, from 1980 to 2025, silver couldn't break $50. Every rally was met with paper supply and price suppression, but 2025 broke through $50, then $55, then $60, and now $67. That's not just momentum, that's structure. JPMorgan accumulated for 14 years while prices were suppressed. They paid the largest manipulation fine in commodity market history. They admitted wrongdoing for spoofing markets from 2008 to 2016. Then they repositioned, from short to long, from paper to physical. And now at $67 per ounce, with structural deficits confirmed and industrial demand accelerating, their position is worth tens of billions. This is not financial advice. This is analysis of publicly available information for educational purposes. Markets are complex, outcomes uncertain, and individual circumstances vary. But the pattern is clear. The largest bank in America spent over a decade accumulating a dominant position in a metal entering a structural supply deficit. They did this quietly, systematically, and at scale. As we move deeper into 2026, watch these indicators. COMEX registered silver levels. If they fall below 50 million ounces, delivery stress intensifies. Silver lease rates. If they spike above 30% annualized again, it signals physical borrowing stress. Premiums for physical coins and bars over spot prices. If these widen beyond 20%, it indicates paper and physical markets diverging. The $67 price is a milestone, not a destination. Based on historical patterns, structural deficits, and positioning dynamics, this move likely has further to run. Whether that's $75, $90, $100, or higher depends on industrial demand growth, investment flows, and supply constraints. But the direction is set. Silver broke out of a 45-year range. Industrial fundamentals support higher prices. And the institution that understands this market better than anyone holds the largest position in history. JPMorgan's silver bet isn't speculation, it's strategy. 14 years in development, $45 billion in current value, positioned for a structural supply deficit that's playing out exactly as fundamentals predicted. One institution controls a dominant share of a critical industrial metal entering a supply squeeze, and $67 silver confirms they were right. This is pattern recognition, not prophecy. Markets reward those who position ahead of structural change. JPMorgan positioned, the fundamentals delivered, and the price is confirming what's been building for over a decade. The silver story isn't over, it's just getting started.